Good morning and welcome to the Appraisal Institute's seminar that we're holding today. The New York chapter is happy to put on a seminar for property tax issues post-COVID. We've got some great speakers and glad all you can attend. Before we do that, I'd like to give a big thank to our sponsors. The Metropolitan chapter is enormously grateful to the firms you'll see here for supporting our programs. Without their help, these programs wouldn't happen, and it's through their generosity that we can do these events for our membership. We've got some other events coming up. We've got a great program in May that we're working on. It's going to feature the Park Avenue train shed and other infrastructure events going on in New York, helping shape New York's future. We haven't given up on a June outing. A June outing is a possibility. It may not happen in June, but time will tell depending on things beyond our control. A little housekeeping. We've got 5 speakers. We'll have plenty of time for Q&A, which will go in the Q&A box. But for attendance, please put your questions. For attendance, please put your name in the chat box. And we're going to have to do this twice, as we've done in the past. So put your name and enter it there. And if you have trouble, email Connie. We've got 5 great speakers today. People, some of whom you've heard, they're members of the Appraisal Institute, several attorneys. They're going to discuss the intersection of property taxes and appraisal practice, how it's affecting the markets. The coronavirus pandemic has wreaked havoc on municipal budgets around the country. New York is suffering severe fiscal challenges, and like every city, they're looking at ways of maintaining their tax base. How are appraisers meant to navigate this going forward? There are a lot of uncertainty. Hopefully these speakers will help unravel the issues that they see coming and how it's affecting various property types and their profession. The first speaker I'd like to introduce is David Wilkes. David's an executive level partner at the law firm of Herman Katz, Jimmy Wilkes & Klein, representing owners and tenants throughout New York. David's a co-founder and president of the National Association of Tax Attorneys and served as chairman of the Appraisal Foundation. He's also a director of the International Property Tax Institute and the co-chair of Westchester County Bar Association's Tax Certiorari and Condemnation Committee. David has a law degree from BU and a master's in real estate from NYU. He's also a member of the RICS and formerly a CRE. He was editor-in-chief of the Real Estate Review, as well as the New York State Bar Association Journal. After David, we'll hear from Glenn Newman, who's an attorney and shareholder of Greenberg Traurig, where he advises clients on state and local taxation. In addition to helping clients understand New York's real property taxes, Glenn advises on income, sales, and corporate taxes, as well as real estate transfer taxes. Prior to joining Greenberg Traurig, Glenn spent more than 12 years as president of the New York City Tax Commission, hearing challenges to New York City's property tax assessments and exemptions. He's also president of the New York City Tax Appeals Tribunal, handling appeals of city business taxes. He served as deputy commissioner of New York City Department of Finance and chief of the Tax Bankruptcy Division, the Office of Corporation Counsel. We're going to hear from Ting Patka, Ting is a partner at the law firm DeVal and Stockenfeld, where she's chair of the New York City Real Estate Tax and Incentives Group, co-chair of the Climate Mobilization Act Task Force, and a member of the Real Estate Practice Group. Ting represents New York City real estate owners and developers on all aspects relating to real estate taxes, such as challenging their property taxes, applying for tax and zoning incentive programs such as 421A, ICAP, IDA, and inclusionary housing, and not-for-profits in obtaining real estate tax exemptions. Additionally, Ting is a leading expert in New York City's Climate Mobilization Act, including Local Law 97. She helps counsel clients on PACE financing and its interconnection with property taxes. Our fourth speaker is Mike Hedden. Michael is the Director of Financial Advisory Service Practices at Houlihan Lokey in New York. Mike's an MAI and holds the CRE and FRICS. He has over 40 years of experience in valuation, participating in several significant cases, and has been actively involved in tax appeals throughout his career. He's been teaching at the Appraisal Institute for over 25 years and has authored many articles and given countless lectures, presentations on the topics of real estate valuation and tax appeals. Lastly, Dan Lesser, whom most of you know, is president and CEO of LW Hospitality Advisors, with 40 years of experience in appraisal, economic feasibility, evaluations, investment counseling, and asset management for all types of hospitality properties. An authority on the topic of hotel feasibility and property valuation, Mr. Lester has served as an expert witness in U.S. federal courts, domestic and international arbitrations. Dan started his career in operations with Hilton and Eurotel Switzerland, and is a frequent presenter at lodging and real estate conferences. Dan earned his BS in hotel administration from Cornell and holds the MAI, FRICS, CRE, and CHA professional designations. With that, I'd like to turn it over to David. Thank you.
Thanks, Mark. And I also, just before I begin, I'd like to thank the Metro New York chapter for inviting us to speak and for having me. I'd also, like to just say that I appreciate all of you who've shown up today, and I guess I only am saying that the only thing that's missing is being able to really see you in person and get to talk with you. I know many of you personally, and looking forward to a day when we can see each other in person. So the way we're going to do this is each of us is going to speak for maybe 10 plus minutes or so about different areas, and then we're going to be able to really open up the conversation for the balance of the time to field questions and kind of have some more in-depth discussion about things that might be of particular interest to you. So what I'm going to do is really start off by talking kind of a very high level, almost like, people say at 30,000 foot. This would be more like a satellite level overview of property tax in New York, and really just kind of highlight some of the topics that I think might be of greatest interest to you as appraisers in how you might engage with the lawyer when it comes to dealing with a tax appeal in New York. And I guess inherently in having only about 10 or so minutes to speak about that, I'm going to have to be very selective about what I choose to speak about. But in the balance of the time, if there are things that I've touched on or things that I haven't touched on, I encourage you to submit questions, and we can get into more detail about those things. So and I guess just if it weren't obvious enough, during a year of COVID, which has had such an impact on the real estate markets, property taxes, one of the largest operating expenses of any owner, are more than ever, a topic of conversation for owners. And New York, compared to probably most of the rest of the country, is one of the most challenging places to address property taxes and to get some sort of kind of quick relief. And so there are many minefields, I'd say, from a legal standpoint. And so as the appraiser, no pressure, but everybody's counting on you to not only, get the value right, but also create a report and be able to provide evidence that is going to, sort of hit all the right bases and not open yourself up to some sort of attack. So, I thought about what I could say to you in a brief period of time that would be sort of the greatest takeaways. And the first, really, I have two primary things that I want to say to you now. One takeaway is when working with an attorney on an incoming property tax appeal where you're being asked to provide evidence of value, I would say go with the familiar, not the innovative. And by that I mean, really having an in-depth conversation with the attorney about the scope of work, about what's expected, and about sort of what I would call the rules of the game is so important. And I'd say the greatest, maybe failures is a strong word, but the greatest challenges that I've encountered in working with an appraiser over the years is where maybe not enough instruction has been given, or maybe the appraiser is making some assumptions about what I'm looking for, and we just miss each other, and so the ultimate report becomes something that's not really as useful as I would hope it would be. So part of that conversation usually looks like me advising the appraiser, especially if as an appraiser you haven't done a lot of tax certiorari work, is to sort of say, here's what a typical tax certiorari appraisal that is successful in terms of meeting the client's needs will look like, both in format and also, and I think mostly in terms of approach. So for example, things like, it's very rare that we would see a discounted cash flow analysis. A direct cap is the preferred way to go. And really, when you think about it, you might say to yourself, yeah, but a discounted cash flow in this instance says so much more. It's so much more informative. But really, what you have to think about is the judge going to get it? Or is the person on the other side, let's say the municipal attorney that we're talking with, are they going to get it? Or do the eyes glaze over? And the ultimate result we're looking for is not sort of the gospel truth about valuation on a property, but it's really to be able to reduce the owner's taxes. So as the advocate, that's where I'm coming from. I want to make a persuasive, convincing argument to the other side that they can really just kind of get. They're dealing with lots and lots of matters at any one time. So I need to get their attention for a brief moment, have them be able to sit for just a small window to look at the evidence I'm giving them. So, going with things that they're not going to sort of immediately pick on or say, this doesn't look like something that I've seen before. I'm not interested in knowing a range of value, for instance. I want to know, what do you say the value is? Things like taking out the real estate expenses. I know many of you are kind of familiar with the practice, but making sure that the real estate expense is treated as part of the cap rate, not part of the actual expenses, because it's the thing that we're disputing. So things like that would be the main takeaways in this sort of little high level overview of how to work with the attorney in terms of preparing the appraisal. Other things that I just highlight, for the most part in New York State, when we're looking at valuation of anything other than vacant land, is that we're essentially looking at value in use. Now this is market value, but for the most part, we're ignoring highest and best use. And I know that that's sometimes, difficult. We're sort of essentially saying that whatever the current use is, other than vacant land, which, if you want to call it a use or not, but the current use, we're going to consider it to be the highest and best use, or however you want to say it. But basically what the point is, and I know that there's some, you could break this down and say that there's some sort of theoretical contradiction in saying that, we're going to treat the current use as the highest and best use. But value in use, in other words, not looking to future potentialities. I mean, that's really the way the courts tend to say it, is the way that we're looking at. Condemnation is completely different. In condemnation, we are looking at a one-time valuation. And so they do look at future value. I guess, again, just sort of from a theoretical standpoint, I often think to myself, yeah, but isn't present value, always going to sort of include that potential value? But that's simply not, I don't want to get into the weeds on that. It's just that that's really not the way the courts look at it. And our job is not, again, as I say, to kind of provide an ivory tower value. It's really to provide the value that's going to achieve the client's desire, which is lower taxes. So that's something, and we can certainly talk about that a bit more later today, is value in use. And the other thing, well, maybe two things quickly. I've only got a minute or two here left, but I'll just mention getting the valuation date is so important. And in New York, we really have two dates to be mindful of. We have a valuation date, which is really looking at the market for property as of a certain date, and that date is going to be different depending on what jurisdiction. So I'm not going to throw out dates, because if you're in New York City, it's one thing. If you're in Westchester or somewhere else, it may be something else. Even within county, I mean, that's the other thing about New York State. It's such a hodgepodge of rules and dates and rates and everything, from one town, city, village, sometimes within a town, you may have a village in suburbia, and they've got not only two sets of rates, and I'm talking about equalization rates, tax rates, all that stuff. You may actually be dealing with two assessors for the very same property, and they have two entirely different values. So talk about a complicated system to work within. But the point is that the valuation dates are critical. And so the valuation date is going to relate to the market, but you also have a taxable status date to be concerned with, and that's a different date, generally speaking. And the taxable status date is going to be the condition of the actual property. Was it in existence? Did it burn down? And so that's something to be mindful of. And that's why sometimes a client will come in and say, well, I don't need to hire an appraiser for a tax certiorari proceeding because I already have an appraisal. And I might say, that might be helpful to some extent in terms of dealing with the, sorry, I've got something popping on my computer. That might be helpful in terms of dealing with just a very light, high-level negotiation with the assessor, but ultimately it's not really going to be the evidence we need because it doesn't adhere to the jurisdictional standards regarding the dates. Last thing I'm just going to mention, and this could be a fruitful topic for conversation later among the group, is the impact of sales. A recent sale that's arm's length is, generally speaking, in New York considered evidence of the highest rank. And highest rank is actually the language that the Court of Appeals has used, and that terminology is used again and again. And, sometimes it helps, sometimes it hurts. And sometimes the sale is cited by the assessor, and sometimes the sale is cited by the taxpayer. And sometimes you're in New York City where the sale may not matter at all. So again, understanding sales and understanding where the property is located and how the sales may be relevant is really important. One thing I just gave a presentation a week or so ago for the ABA IPT group, and we were talking all about the impact of sales on property tax appeals, and this question of whether a sale might really reflect a least fee basis purchase. And the standard in New York is fee simple unencumbered, but we have so much debate about what that means. What is unencumbered? Is the sale distressed? Or the reverse? Maybe there's some reasons why a buyer paid more than market value, and those are all sort of what I would say is kind of getting under the hood to really look at the sale. But the reality is that many assessors will utilize the sale based on what works for them, and taxpayers too. I mean, both sides will tend to use sales when they're useful and discard sales when they're harmful. But the other thing is, I think that in my experience, at least, most courts are not going to be willing to go too deep beyond the sale. There's a sale, it's evidence of the highest rank, the parties aren't related, it's a recent sale. That's often enough. That's not to say that, some courts will not really take a hard look at the sale and whether it's truly representative of market value, but it is an easy benchmark and it's hard to get away from. So it can be an uphill battle. That's all I'm going to say with the time I have. Obviously, there's a thousand other things that I could talk about, but we have a lot of great speakers here, and I'd like to turn it over to my good friend Glenn to talk to you a little bit more about New York City and other things. Thanks.
Thanks, David. Again, I thank everybody in the Institute for inviting me and having this gathering. I've already learned quite a bit from the other speakers in our preparation, so I've gotten my education on this. So I appreciate the introduction, David, and I will be talking a lot about New York City because I spent 12 years as president of the Tax Commission, so that's what I know. I think there's a very similar arrangement in Nassau County with an assessment appeals board, but let me give you an overview of how the city arrives at value initially, and then how you go ahead and contest that value. So every year, this New York City values properties annually. Every year, there is a new assessment that comes out on January 15th based on the value of the property. The tax status date that David mentioned that I will use is January 5th. In New York City, the tax status date is January 5th. So what is the value of the property in use on January 5th? So every year around January 15th, the Finance Department issues its tentative assessment roll. I also was on a different panel from David at the ABA IPT session last week. My panel had two people discussing CAMA, Computer Assisted Mass Appraisals. And one of them was the Assistant Commissioner at the Department of Finance, Carmela Quintos, who I know for many years. And she made the point that New York City values the 700,000, roughly 700,000 class 1 properties. That's 1, 2, and 3 family homes. Again, New York City and Nassau County have a class system. 1, 2, and 3 family homes are in class 1. Those are valued based on sales, comparable sales. And you know how to do that better than I, but the good news is the city publishes the sales of every property in the city of New York every year. They update that file. So you can see exactly what the next door neighbor's property sold for. They also value a few hundred utility properties, REUC properties, and those are valued based on cost. It's replacement cost, new, less depreciation. And those utility properties, there are only a few hundred of them come through the tax commission every year, but those generally go on cost. Everything else, income producing properties, even properties that are owner occupied, those are valued on a capitalized net income basis. And it is the property in use is the basis for that. Whatever the property is used for currently is what the basis of the assessment is. So Carmela mentioned, or Assistant Commissioner Quintos mentioned, that roughly 80 to 90% of the income producing properties are valued based on the CAMA system. So they've taken certain descriptive data, as well as the income and expense statements that are filed annually by owners of property, and use that to derive their values for the properties. So finance is using that. They publish their guidelines. They tell you in the notice of value that goes to the owner of the property what income they used, what expenses they used, and the cap rate they used. It gives you all three moving parts to determine what the value is for capitalized net income. They will impute income for excessive vacancies. They will impute income for owner-occupied property. They will adjust expenses. And I always use the example, if I'm a property owner and I have to, my wife makes me hire my brother-in-law as the super and pay him $50,000 a year, and every other super in the city of New York is making $35,000 or $40,000 a year, those expenses will be reduced. People have until, and the cap rate is always subject to discussion. The real key here, though, is that the finance department is valued properties for 2021. The value as of January 5th, 2021, based on income and expense statements that were filed for the calendar year 2019. They got those income and expense statements last June. They look at them, they process them, they put them through the CAMA system, come up with their guidelines, and they issue an assessment that is based on 2019 numbers for the 2021-22 tax roll. Clearly, that creates issues. Finance did do sort of an across-the-board reduction for certain properties. I know they did it with hotels and office buildings and certain others, but they were just making guesses. So if you're not happy with the finance department assessed value, you can go to the tax commission. You had to file your protests on income producing properties by March 1 with the income and expense statements that were due last week, March 24th. Those income and expense statements will show 2020 income. So right off the bat, you have the finance department using 2019 income, net income, and you have the tax commission using 2020 income, which is, I can guarantee you, quite a bit different than the 2019 numbers. With the tax commission, they're giving hearings. They went through their hearings last year. The good news was that they didn't really shut down the tax commission in-person hearings until late, well, mid-April or so. So some high value cases were heard in person. Very few of them, most of them were done over the phone. Everything else was heard on papers, which is much more difficult to actually communicate the details about that property by just submitting a paper saying, this is the income I think the property generates, this is the expenses that are legitimate, and this is the cap rate I used in order, to get a reduction. So there's a real crimp in the style of the tax commission not having that interpersonal back and forth with the hearing officer. The tax commission also issues guidelines. They're trying to help people. One of my favorite phrases when I was president of the tribunal, they gave me a t-shirt that said manager of expectations, which is what I try to do. You tell people this is what you need to show, this is how you do it, and that gets everybody at least on the same page. So they have their guidelines. The tax commission hearing officers are used to trending, which may not be appropriate in these circumstances. And they will also coordinate. If you're a practitioner and you're working with both cases at the law department as well as the tax commission, you can, in fact, try to get the two agencies to work together and come to a value and to make an offer of reduction that includes the more current years that the tax commission can hear and old years that the law department is handling. I used to describe it this way when I was doing public speaking and trying to explain to people what the tax commission does and how they do it as part of the process. You go to finance, puts out an off-the-rack number. It's primarily computer-assisted mass appraisals. They don't necessarily have the details on every property. They certainly don't have the income and expense information for a more current year. So what you get from finance is off the rack in the context of tailoring. You come to the tax commission can let out the waste or take in the waste, shorten the sleeves, maybe put cuffs on the pants and do a little bit of tailoring. But if you want a custom suit, you got to go to the law department because they will spend years going over the income and expenses in every detail and try to resolve the case. Or, there have been very, very few trials of tax certiorari cases. But basically, if you want a custom suit, if you have things that are incredibly unique to a particular property, you may have to go to the law department to get the result you're looking for. I think that's about my 10 minutes. Ting, you want to talk about exemptions?
Thanks, Glenn. Hi, everyone. I'm Ting Packa, and today I'm going to be introducing to you 3 popular tax exemptions that are used by New York City commercial real estate owners and developers. They are 421A, ICAP, and nonprofit, otherwise known as 420A. 421A is named after the section in the real property tax law. It is used by market rate residential real estate developers in New York City. In fact, it is the only real estate tax exemption program that market rate developers can use. It is what it is that it exempts any increase in assessment resulting from construction. It is not 100% exemption off of real estate taxes. You still do have to pay what we commonly refer to as the mini tax, which is generally the taxes that you pay before construction begins. So the 421A benefit period is 35 years long. So during that 35-year period, any increases are exempt, and all you have to pay during that 35 period is the mini tax. 421A requires developers to provide on-site affordable housing. The range of affordable housing is generally between 25 and 30% of the units that have to be affordable. And the affordability also varies between 40 to 130% of AMI, depending on which option that the developers choose from a menu of options that the 421A provides. To be eligible for 421A, the project has to contain at least 6 residential units. And all of the residential units in the project have to be rent stabilized during the benefit period, unless the rent is above the rent deregulation threshold, which last year was about $2,718. So what that means is that any units that were rented out above that deregulation threshold did not have to be rent stabilized. And if any units going forward eventually reach the deregulation threshold rent, they can be deregulated. So 421A is one of the only programs left that allows New York City unit owners to deregulate rent stabilized units. Furthermore, to qualify for 421A, you must commence construction by June 15th of 2022, and you must complete construction by June 15th of 2026. Commencement is defined as starting construction on your foundation. So you must have shovel in dirt by next June, and completion is a temporary CO or permanent CO on all residential units. 421A is expiring next June. And we don't know right now what the future of the program is. It's still too soon to tell. So because of that uncertainty, developers, brokers, lenders, and appraisers like yourself will probably see an uptick in activity in the coming months as developers scramble to get their projects into the ground by next June. The next program is ICAP. ICAP stands for Industrial and Commercial Abatement Program, and it is used by commercial and industrial developers and owners in New York City when they rehabilitate, modernize, or build new commercial and industrial buildings. The use and the location of the building determines the length of the benefit, which generally ranges between 8 and 25 years. The way the ICAP benefit is measured is somewhat similar to how 421A is measured. Very generally, ICAP will abate or exempt any increase in taxes over a base year. ICAP has a spend requirement it's referred to as a minimum required expenditure. What that is that the owner must spend at least 30% of the taxable assessment on construction. So for example, if your building is taxed at $1 million, you will have to spend at least $300,000, 30%, to qualify for ICAP. If you spend $750,000 or more on construction, you will be required to solicit bids from certified MWBE firm companies, minority and women business-owned enterprises, on all of your construction trades. You're not required to hire them, although we do strongly encourage you to hire at least one, but you will be required to solicit bids for projects that cost $750,000 or more. If your project costs $2.5 million or more, you will have an additional employment reporting requirements to show compliance with the equal employment opportunity laws. An important thing to remember for ICAP is that ICAP applications must be filed prior to pulling your first construction permit. This catches some owners by surprise. So it's always a very tragic phone call for me to have when they call me and tell me they've already pulled a permit, and I have to explain to them that they have become ineligible for ICAP. The ICAP law was set to expire next year, but it was quietly renewed in last year's 2020 budget in Albany. So the new expiration date for ICAP isn't until March 2025. So we're good there. Finally, the not-for-profit exemption, also known as 420A, which is the section it's found in the real property tax law. It's unlike 421 and ICAP in that it does exempt 100% of the real estate taxes for as long as a property is owned by a qualified nonprofit and for as long as it's used in a qualified exempt manner. So in order to be eligible, there's a two-pronged test to see if you're eligible for a not-for-profit exemption. Number one, you have to be a qualified exempt owner. And number two, you have to use it in a qualified exempt use. Now, I emphasize the term qualified because not just any nonprofit will be eligible for this exemption. It's commonly misunderstood that 501c3s means an automatic entitlement to a nonprofit, and that's not the case. You have to be a certain kind of nonprofit found within the statute. And you also have to use it in a qualified manner. So for example, I use is a church that owns a warehouse. So a church, as an owner, it's a religious owner. So under the statute, it would qualify as a qualified exempt. But if it owns a warehouse and uses the warehouse for storage is not a qualified exempt use under the statute. So even though it's owned by a church, the property itself would not be exempt. I often get asked the question, what if the church rents part or all of its space to a tenant? Is it still exempt? And the answer is it depends on who the tenant is and how it's being used. If the tenant is for profit, then that portion will not be exempt. For example, if the tenant rents 15% of the property, then the church will only get 85% exemption of its property taxes. If the tenant is a nonprofit tenant, the landlord church may get 100% exemption. The nonprofit tenant itself has to also be a qualified exempt owner and use the space in a qualified exempt use. If those two prongs are satisfied, then there's a third test where the landlord, the church in this example, cannot make a profit off of the lease, meaning that the income cannot exceed the expenses, which is defined in the statute as maintenance, depreciation, and carrying costs. Another question that I get asked is, well, what if the church rents from a for-profit tenant? What happens? Can the church in any manner get an exemption? And in that case, the answer is yes. What I advise clients do in that scenario when there's a for-profit landlord and a not-for-profit tenant would be to create a leasehold condo where the two parties enter into a ground lease and then create the leasehold condo, which would confer ownership onto the nonprofit tenant, which satisfies the requirement that the nonprofit own its space. This leasehold condo regime idea, it's not in the statute. It is an interpretation by the Department of Finance for a while ago. And it's their current policy to grant exemptions under the leasehold condo regime. However, we do warn clients that this policy may change at any moment. So that concludes my discussion on the three most popular exemptions in New York City. And now I'm going to hand it off to Mike Hedden.
Thank you, Ting. Hello all, and thanks to the chapter for inviting me to address you today. So let's begin with what many have conceded about this pandemic and put a label on it in terms of appraisal terms, along with some key observations associated with real estate valuation, considering we're in a post-COVID environment. As you've heard many say, this health crisis did not start out as a financial crisis. However, the health crisis that caused the Great Lockdown morphed into a financial crisis for many individuals, businesses, and property owners. Some of the economic cost of the pandemic is manifesting itself in a reduction in the value of certain real estate assets. So therefore, if you had to put a label on it, the pandemic has caused certain property types and uses to be distressed or damaged and suffered from forms of accrued depreciation. So there's your appraisal terms, and we'll get into more later. As we know, property values are going to vary between asset types and quality and location. And the damaging effects of COVID have not affected all properties or locations equally. However, as it relates to property tax issues, the asset categories that have suffered the most in certain locations are those the most likely in need of tax assessment reductions. So if we had to list them, you've got retail, restaurants, theaters, hotels, gyms, offices, parking lots. Need I go on? Just reading the Wall Street Journal from this weekend on the front page article, quote, lower rents could help revive a bruised Manhattan, summarizing the new lower rent levels in the city. And on today's Wall Street Journal front page on office subleasing, downward pressure on office rents are going to go compete with the direct space from the market, obviously going to compete and put downward pressure on those rents. So factors to consider include the imbalance of supply and demand, the availability and the cost of debt and equity, liquidity and the number of types of transactions, and the conditions of sale, which you've heard recently addressed, and the repurposing and the reuse of certain properties. However, given the fact that we're valuing in use, those are things to consider, but not be upfront in your analysis. So as you know, in real estate, there's fundamental cycles and there's capital market cycles. And obviously, this is not a prohibitive capital market cycle, as spreads and interest rate cap rates and discount rates are historically attractive. And that could be prohibitive when you're trying to discuss it on a terms of a cap rate basis. However, this is a fundamental shift in a cycle whereby the pandemic has caused dramatic changes on how people live, work, play, and use real estate. The retail and the residential and office and entertainment uses have been dramatically altered. Do they ever return to pre-pandemic levels? The fundamental concepts in market analysis and highest and best use involve detailed analysis of interim uses, feasibility, and maximally productive considerations. Specific attention should be paid to demographic shifts, income and spending patterns, mobility, travel, especially tourism, as it means so much to the New York City economy. Be mindful that there were 70,000 people that left the New York metropolitan area during this pandemic. So let's briefly visit the situation that taxpayers face. Oftentimes I say there's reality and then there's tax court. But for the most part, governments are in a fiscal crisis, right? Governments rely upon ad valorem tax on real estate as a significant portion of the revenue. And oftentimes politics, think about this, politics clouds the judgment on property values. There is a presumption of correctness of that tax assessment, and the burden of proof to overturn an assessment is on the taxpayer. So the courts have set very high hurdles for the level of proofs and the preponderance of evidence. So therefore, it's incumbent upon the appraiser as the expert witness to educate and persuade the assessor, the Board of Assessment Review, or the courts that they have applied the appropriate facts, analysis, methodologies, and judgment in supporting their opinion of value. And that's crucial in today's environment. We'll get into that in a minute. So following the guidance of counsel, as David has suggested, and then using the best market data and analytics supported by the latest treatises and institute teachings, we hopefully will build a record and result in court decisions that will reflect the reality of the post-pandemic real estate market. For those municipalities where there's an equalization ratio based on sales studies, the dominance of the formula towards a residential sales price will have an escalating effect and will cause the ratios to fall. So also on the journal today, you could see, as we all know, residential properties have been escalating dramatically, while commercial properties are not increasing in value at the same rate as residential. So you're going to apply a lower equalization ratio to commercial properties that have best held their own and are most likely decreasing, and will manifest that overassessment. So David earlier alluded to the fact of the impact of sales as being the highest rank. And I would agree that in many cities and government agencies, I mean, the sales are the most important. But from a sales comparison approach in this market, it's hard to measure the impact, the exact impact of the pandemic on prices due to the relatively few number of transactions that have occurred, coupled with the lack of transparency surrounding some deals. The large amounts of investment capital, both debt and equity, are referred to as dry powder, are looking in for opportunities to enter this market. And well, I'm currently involved with what they call forward sales. But again, we'll discuss that later. But, very cautious underwriting by lenders and opportunistic buyers are capitalizing on strategic locations or waiting for sellers to acquiesce to their bid price. But as the reality of the new economy unfolds, hopefully we'll expect buyers and sellers will come to a more agreement over value, and more sales will occur, and that becomes more evident in market transactions. But getting to a key point here, it's the obsolescence and depreciation can be characterized as either an economic or external because of the outside forces, or functionality, a functional obsolescence issue because of the design to meet current requirements. And this is going to be a key argument that you're going to make in terms of analyzing much of your transactions. Some of the functional obsolescence can be curable or not curable depending on the situation. And it's incumbent upon the appraisers to carefully analyze, measure the accrued depreciation in the valuation of the property, and be able to explain it to the court or the assessment body in those terms. An important aspect of tax appeals that are coming up in recent conversations and other tax professionals is the insurance claims, is the reliance on the physical improvements required that have resulted from the pandemic, specifically CapEx and the improvements necessary to maintain the property in a post-COVID standard. So you include barriers, elevator banks, the additional functional improvements that had to be made and maintained. Recent lawsuits with insurance companies like RWJ Barnabas, just recently, they claimed physical damage and that the pandemic made the properties uninhabitable, unsafe, or unfit for their intended uses, likening the virus to asbestos. RJ didn't do this, but other insurance claims are likening the virus to either asbestos, ammonia, or salmonella outbreaks. The key aspect is that the actual physical presence of the coronavirus on door handles, miscellaneous surfaces, heating and air conditioning systems. I think a focus on the expense side of the ledger is its impact on NOI and its duration could carry more weight in your argument, along with the interpretation or in conjunction with long-term reduction on the revenue side because of reduced occupancy or density of use. It's the tie to the physical aspect and the depreciation, which I think becomes crucial in the argument, because there is case law in California, for instance, that goes to the physical aspects. The courts have traditionally cited the Appraisal Institute. So here's where I'm going to get a little wonky with appraisal stuff, because the Appraisal Institute, quote, the appraisal of real estate is one of the most reliable sources in real estate valuation. The courts have cited all the time. So if we call that the rule book, relying to what David was talking about before for the game, and through a convincing argument, can we bend the rules a little bit, to meet the current post-pandemic economy? Most, if not all, tax districts prefer direct capitalization methodology in the pursuit of those tax appeal reductions. Well, a direct cap methodology, which is not often thought of in tax appeal situations, for those who remember early Appraisal Institute techniques or teachings, is the use of the Elwood analysis in direct capitalization. Now, the Elwood formula, with its comprehensive algorithms, gave way to a streamlined algebraic equation proposed by Charlie Akerson, who was also an MAI, and is a form of a yield capitalization that takes into consideration debt and equity, as well as the change in property value over the projected holding period. So it's a direct cap, but you can make those adjustments using that technique. And prior to computerization and discounted cash flow, it was the primary tool that appraisers used to adjust for the change in the overall income and property value. It was taught extensively in early cap courses, which I taught, and could still be useful today to overcome some hurdles when only a direct cap method is being considered by taxing districts or courts. So I looked at the 15th edition prior to my preparation today, my presentation, and I found a lot of relevant passages. So if you have a pencil handy or you listen to the recording later, just note some of these page references. Specifically on page 375, it references statistical theories or trend analysis, or the use of statistical techniques to make comparisons of variables other than time. And on the same page, it discusses capitalization of income differences, that differences in net operating income that can be capitalized to derive an adjustment when the income loss or gain incurred by the comparable property reflects a specific deficiency or benefit to the property. On page 387, and I quote, "In a depressed economy, recent non-distressed sales are often difficult to find older sales occurring prior to the onset of the depressed economy, and should be used with great caution because they may not reflect the problems associated with the depressed economy. And in some instances, when current sales of improved properties do not exist, upward or downward shifts in rent or rental terms or land values may help appraisers identify the direction of the market activity." And to continue, on page 388, "In a downward economic cycle, prices fall and negative market conditions adjustments are needed in sales comparison analysis involving sales data from those periods of market decline." So getting away from that for a little bit, the recent public articles discussing the appraiser's review of prior transactions have been helpful in doing and re-underwriting a deal and look at the changes in the value that would result from new economic environment. So if you do a collection of the surveys from your sources like Real Capital Analytics, CoStar, Reese and Moody's, Green Street, develop a consensus of those experts to be used in anticipation of future market changes. Getting back to the 15th edition for just a second, on page 389, changes in sales price can be irregular or stepped, and they can increase or decrease on a compound basis, or they may require identification of inflection points or dates which changes in trends occurred. Statistical tools such as regression analysis or extrapolation are useful in determining precise mathematical relationships. However, statistical model generation from the available data must reflect market thinking and is useful in the adjustment process. And rents can also be plotted on scatter diagrams to show differences over time. And I hate to be reading all this stuff, but it was just so germane to what we're talking about today, because as an alternative to the direct comparison of properties with or without external obsolescence is the capitalization of income loss due to the effect of the externality, and if necessary, allocating the estimate of the loss in property value between land and building. So that was on page 594, and it was done during the last cycles where we've had this offsetting of value as a result of income losses. So here we have a capitalization of income loss that is anticipated to be lost over this ramp-up period or the recovery period. And they can be capitalized by estimating either a gross income multiplier or a gross income loss overall capitalization to the net income loss. The lost income is not anticipated to be long-term. It's used as an adjustment, and you use a discounted cash flow analysis. So again, it's an adjustment to your comps in your sales comparison approach or your overall cost approach analysis. So that's the end of my 15th edition references. But clearly, we've talked about the importance of using that discounted cash flow. In the interest of time, I'm going to jump ahead really and just like to close, so I realize I've run a little long, with this mission statement from the Appraisal Institute, and it's incumbent upon us to educate the triers of the fact as to what is current thinking and how that adapts to a unique environment. And our quote, our mission is to enhance professionalism and ethics, global standards, methodologies, and practices through the professional development of property economics worldwide. Close quote. So it's up to us here in the greatest city of the world to live up to that mission. So that concludes my presentation. I'll turn it over to Dan Lesser.
Good morning. Thank you, Mike. Appreciate the handoff. I felt a little aged for a moment when you were talking about Elwood and Akerson. Not sure that some of the younger folks on this call would. Well, I guess everybody's taking the basic classes. Anyway, greetings from Miami. I'm actually on my first trip since COVID began. Got on a plane last night, staying at a hotel. I won't identify specifically which hotel. What I will tell you is I'm shocked at how dirty the hotel is. So with that as a backdrop, I have a bunch of slides that I'm going to go through. Let me do the slideshow. Okay. So hotels, what makes them different? I'm sure everybody realizes it, but I think it's important to set a backdrop. Hotels are unlike any other form of real estate, commercial real estate, right? Daily leasing, with technology being what it is, room rates change literally by the nanosecond. In an up market, that's a beautiful thing. In a down market, it'll kill you, just like what's happened over the past year. There's no credit tendencies, again, because of daily leasing. Very compounded complexity, right? You have debt, equity, an operator, many times a franchise. So there are all these competing interests, and many times the interests are not necessarily aligned. The hotel business is very high leverage business with high fixed costs and reliance on intermediaries, right? Think about hotels on islands, right? And if air service curtails to that island, well, the hotels are definitely going to have a challenge. So the bottom line is hotels are very complex and volatile business. And I want to make sure this sets the backdrop for talking about valuing for hotel property tax purposes or assessment purposes, right? Hotels have three agents of production, and these three agents are very much intertwined, right? You have the real estate, you have the FF&E or the furniture, fixtures, and equipment, and then you have the operation, right? The operation is the business, right? I already explained the hotel business is a complicated business. Typically, experienced entities are the ones who day-to-day operate hotels, whether it be third-party operators or chain hotel companies, and we're going to talk further about that in a second. Another point that it's very important to remember is that hotel companies, whether it's chain or independent, they have significant investments in all sorts of assets that include assembled workforces, accounting systems, operational policies. And then, of course, chain hotel companies also have a major investment in their trademark brand names and their proprietary reservation systems. So, not to belabor the point, but again, hotel operations are sort of like they operate the way a sports team would operate, right? With different departments responsible for different aspects of the operation. You have a general manager, an operations manager, front desk, director of engineering, director of IT, director of security, housekeeping, et cetera, et cetera. All these folks have very different skills. Right? Again, it's a complicated business. So from a historical perspective, valuing just the income attributable to the real and personal property. So the goal here is to get rid of the business value, right? Or the operational value. And we've already established that operations is clearly a different function than ownership, right? So in the old days, leases of hotel properties were extremely common, right? So an operator would lease a building, either with personal property or without, and then if it was without, they brought their own personal property in, but they would lease the land and the building at a minimum, right? And so, back then when you had, traditional formulas that were some fixed amount against a percentage, the percentages were typically 25 of rooms, 2% of food, and 5% of beverage. So once you had that income from the rental, the actual rental, you could capitalize that into an estimate of value, and there'd be no argument about that income is purely attributable to the real estate. Hotel leases fell out of favor in the 1970s, and since, with the advent of the hotel management contract, essentially, hotel operators that used to lease properties realized that the risk was all on them, right? They had to pay rent no matter whether they had $1 coming in or $1 million coming in, right? And somehow they were able to shift that risk over to ownership and come up with what's called a management contract, which is basically fee-based. And we're going to get into, some further details about that. Hotel management allows for, separation of ownership from day-to-day operations. Again, they're two, completely distinct silos, if you will. Lots of hotel owners don't necessarily have the expertise to manage a hotel, or even if they do, they may not desire to get involved in day-to-day management. Hotel companies, it's important to note that while they do have investments in their assets that they try to leverage off of, to get into deals, typically it's little or no upfront financing or equity needed. And the goal for the hotel management company is to create income stream and as durable as possible for them. So we have two types of hotel companies. First, chain hotel management companies, right? And these are, brand names that everybody, knows in terms of the parent company, whether it be Marriott, Hilton, Hyatt. And then to the right are the various brands within their brand family. Marriott, for example, has 30 different brands. Chain hotel management fees are typically comprised of a base fee, and we'll have an illustration of this momentarily, and an incentive fee. The base is off of gross, and the incentive fee tends to be off of some defined bottom line. And then you have independent hotel management companies, right? So I would imagine for many on this webinar, while you've heard of all these brands here, there's a good chance you may not have heard of some of these hotel management companies. Aimbridge, Benchmark, Highgate, HEI. If you are in the hotel space, you recognize these names, and these are premier companies in the hotel world who do terrific work day-to-day managing hotels, whether they be independent hotels or branded hotels. And again, their fees are typically also comprised of a base fee, which is calculated off the gross, and then incentive fee off some defined bottom line profit. Okay, so franchising in the hotel industry, right? Marriott, Hilton, Hyatt, we just talked about them. They provide management, right? But what they provide more of is licensing of brand identification and a supporting reservation system, right? So Marriott, Hilton, Hyatt, they don't really own that many hotels. They manage a lot and they franchise a lot of them. And the franchise ones tend to be managed by those independent hotel operators. So to obtain a hotel franchise, you end up paying royalty fees amongst some other fees, but you pay a royalty fee for the use of the name, right? So a Courtyard by Marriott, there's a royalty fee that's due Marriott for using that brand identification and supporting reservation system. Okay, so let's just talk for a minute about encumbered versus unencumbered hotel assets, right? So the first thing that a lodging sponsor is going to do when they consider investment in a hotel is ask the question, is the hotel encumbered by a hotel management contract or not? Generally speaking, the market pays a premium for assets that are available unencumbered by a hotel management contract. And the notion being that the arena of prospective buyers is much wider for unencumbered assets versus encumbered assets. It's not that one is better than the other. It's just there's a larger arena for unencumbered assets. And the bottom line is that an ownership interest in a hotel encumbered by a long-term management agreement, which is sold subject to that encumbrance, it's an entirely different entity that owns the asset versus manages the property, and the asset being the real estate and the personal property. So just drilling down a little bit further, let's talk about unencumbered hotels. If Hilton owned and operated a hotel, a 400-room hotel, and sold it to Hyatt for $80 million, essentially what Hilton would be acquiring is the real and the personal property. And then if, Hyatt were to say, oh, okay, that's great, now pay us another $10 million for our assembled workforce, business name, copyrights, et cetera, Hilton would say, well, thank you very much. We have our own investment in those arenas, so there's no value associated with that for the buyer, okay? So again, this is important to note, in an unencumbered hotel, it's real estate and personal property that ultimately is what is sold. There is no business component that's sold. And then you have encumbered hotels, which long-term hotel management contracts are layered onto the asset. It runs with the real estate, and there is no shortage of buyers of passive interests in hotels. Many of these folks are investors and financial engineers, and may know something about the hotel business. The bottom line is it's no different than an investment in a Class A office building occupied by a long-term tenant. Granted, it is a riskier position in a hotel. So if we drill down a little bit further, Pebblebrook Hotel Trust, they're publicly traded on the New York Stock Exchange. PEB is the symbol. If we were to just look at a 10K, this is from March 2010, and if you just quickly review the last bullet point, we will not have the authority to require any hotel to be operated in a particular manner. All right, and it goes on and on and on to describe the passive interest that they have in owning this hotel. So they own the property 100%, but they are not involved in the day-to-day operation. So there's a clear illustration here of a division between ownership of real estate and personal property and the business, two entirely different silos. And then if we drill even further, Pebblebrook bought a 450-room hotel in San Diego, the Westin Gaslamp. And if you drill down and look at their 8K, it specifically articulates the purchase price shall be allocated among the land, the improvements, and the personal property. And then it goes on to break out what those allocations are, right? And it totals up the sale price of $110 million. Note, there is no attributable value whatsoever to any intangibles or business. So again, unencumbered or encumbered, it really does not matter. Market participants allocate income attributable to the business through a deduction of management fees, and in many cases, additional cost of franchise royalty fees. So what actually transfers when a hotel is sold, right? It's everything to the left. It's the tangible taxable property, the real property and the personal property. And to the right is a completely separate asset and ownership interest, and it does not run with the real estate. So let's look at a quick example here. Chain hotel companies versus independent hotel management companies. And actually I pulled this from an actual tax matter that I worked on a hotel in California, fairly sizable asset. It happened to be chain managed, right? So, here's the calculation to strip out the income attributable to the business, right? So you have this net operating income coming out of the operation, and we need to get to the net income just of the real and the personal property. So again, as I talked about earlier, a base and a management fee, and if you do the math, $1,920,000 would be the business value allocation. If this hotel was franchised and managed by one of those independent hotel operators, the independent hotel operator would get a different structure in terms amount in terms of fees, right? But the structure would be the same: a base and an incentive fee, right? And then there's an amount due to the brand hotel company, a royalty fee. So here you do the math under that premise, and it's $1,980,000. So for all intents and purposes, $1,950,000, call it, is the income attributable to the business. And then there's the personal property, right? Because we want to get down to just pure real estate that is taxable, right? So you take it's very simple. You take a return of, a return on. A return of is very well represented by reserves for replacement. That amounts are articulated all the time in hotel management agreements, anywhere between 3 and 5% of gross revenues. And then a return on investment would be by taking the value of the furniture, fixtures, and equipment, and taking some sort of a return. In this case, using a base rate of almost 8%. So to get to the value of the real estate, which is what we're looking to solve for, right? Stabilized net operating income. After deduction of these prior amounts, and then capitalized with a loaded cap rate. I think David alluded to this earlier. It gets us to the indicated market value of the real estate only. Okay, so we've already stripped out the net operating income available to the business and the personal property. Now, a lot of what I've talked about is known as the Rushmore approach. Steve Rushmore did not invent the Rushmore approach. However, it was labeled by many judges after hearing the methodology presented by Steve, who, as many know, is the founder of HVS. The Rushmore approach is clearly utilized for virtually all hotel appraisals for any purpose, whether it's for financing, whether it's for condemnation, whether it's for property tax disputes. It's the same methodology. There is not one methodology for financing and one methodology for property tax purposes. Now, of course, there are owners out there who do get appraisals specifically geared for property tax purposes with the goal of getting as low a number as possible, right? And then they'll go to another appraiser for financing to get as high a number as possible. Well, I guess anybody can do that, but that's not really the way it works, right? There's only one market value. It doesn't matter what the purpose of the appraisal is. And if you look at many courts of law, and I'm not going to go through each one of these cases, but everybody's going to get a copy of this recording, and I believe this handout. There are so many cases out there that validate that the quote unquote the Rushmore approach is the appropriate methodology for valuing hotels and specifically for property tax purposes. And here you have, these cases go back as far back as the 1980s, I believe, and all the way through this last one here, February 17th, 2021. I mean, it's pretty clear. The board agrees that the Rushmore method most closely aligns with what occurs in the actual market for hotels. So just real quickly, I kind of bring everybody up to date where the sector is. I'm almost done here. An amazing 10-year run of positive metrics, and then COVID hit, and 2020 ended up becoming the worst year on record for U.S. hotels. Quite remarkable, because 2019 was a record high and 2020 a record low. And again, a lot of that fueled by daily leasing and constant repricing of guest rooms. But there are a lot of reasons for optimism, right? And I'm not going to go through each one of these, but remarkably, the stock market is at an all-time high. Savings rates are also at a very all-time high. People have been home and not spending money on services, right? So net worths have increased, and there's so much pent-up demand. People are just dying to travel at this point. And I really believe that come the summer, we're going to see an incredible bounce back. And I believe it's going to endure through the fall. The big challenge for the sector right now is not leisure, because drive to leisure was already proven last summer, right? We're still seeing it now, and we're even seeing people getting on airplanes for leisure purposes. Business, I mean, look at somebody like me, right? It's been a year. I finally got on a plane, right? I plan on attending conferences, which is actually why I'm in Miami today. We're going to get back to normal. Group meeting is really the challenge. That's what's taking the longest time. But I think we're going to see a bounce back very, very robustly, and it'll be a beautiful thing. I think it's safe to say that at this point, the hotel industry is in the first inning of a recovery cycle, perhaps the bottom of the first, and there's lots of reason for optimism. Thank you very much.
Thank you, Dan. Thank you to the other panelists. Terrific presentation. A reminder to everybody, for attendance purposes, put your name in the chat box for question and answer. Put it in the Q&A. If you have any difficulty reaching us, you can follow up with Connie directly. We've got a lot of interesting questions from the audience. One that's on my mind, which is open to all the panelists, is: are we expecting a wholesale reset of tax assessments due to the COVID crisis? Are we seeing an across-the-board change because of fundamentally different markets? And how is the stress on municipal budgets going to push against that? Any volunteers to go first?
Well, I'll jump in on the budget process. For those of you who don't know, the way the New York City's budget works is that the Office of Management and Budget comes up with what they believe, they estimate how much revenue is going to come in from the vast array of city taxes: corporate tax, sales tax, income tax, transfer tax. Real property transfer tax has dropped off quite a bit in the last year. But they try to, and grants from the federal and state government. So they try to figure out how much revenue is coming in from all of that. Then they decide how much they want to spend. And the real estate tax is the filler. Makes up the difference between the revenue that's estimated from other sources and what the spend is. So there could be volatility on tax rates, especially since the city did reduce values for major office buildings and hotels, which were, considerable drivers of the real estate tax assessment. I know that the city council is loath to raise rates because the 700,000 homeowners also get hit with those rate increases, and those are the people that vote for the city council members. So there's a pitch to hold the property tax rates where they are, and because the city got about $6 billion from the federal government in the last COVID relief package, it's possible that rates may stay stable or possibly only increase a little bit this year till they let the dust settle and see where the rest of the budget, rest of the revenue comes in.
I'd like to just jump in here for a second. I can tell you that every existing hotel owner, tries to convince themselves that their property taxes are going to go down next year and the year after. And it's an absurd notion. Their assessments will probably go down, right? No question about that. But every municipality in America, for the most part, is broke, right? So, the notion of declining tax burdens makes no sense. And quite frankly, if you talk to buyers out there, there's no buyer whatsoever who's underwriting declining property taxes.
What I'd like to jump in about is, I was thinking about this morning, is this an anomaly? This is the first time in over my 40-year career that I've seen where you can have significantly divergence in property trends and values. Industrials are going up significantly. Well, we got residential, but let's take commercial. You can have retail. Your retail malls are suffering because it's interior, but your strip centers and your outdoor power centers are relatively holding their own, especially if you're a grocery anchored or you have another strong base. So, you've got the multifamily market that's moving in a different direction because it's a fundamental change on how people are using real estate. It's not a capital event because there's plenty of debt, there's plenty of equity, and the cap rates aren't moving much. It's all on the credit quality of your tenants, your income flow, and your bottom line NOI, and how this new economy is going to affect your revenue going forward and the growth of that revenue going forward. So you've never seen in my memory a situation where you have such diversity in the valuation. So therefore, getting back to assessments, some assessments may stay the same, and if the municipalities move, they'll increase assessments. Whereas on the other hand, and we've spoken about the properties that have been distressed or damaged, their assessments will go down. Getting to Dan's points and Glenn's point, though, it's the tax rate at the end of the day, which as a result of the fiscal crisis, could be significantly increasing.
Yeah, I'd like to jump in too and just sort of speak to the rest of the state. To the extent that when I last looked, I think something like 2/3 of New York State does not do an annual revaluation. And in fact, New York City, as large as it is kind of an anomaly. It's and so what you end up with in most of the rest of New York State is a real budgeting problem where both, Mike is talking about assessments being reset, but the question is often when. A lot of times you've got tax assessments that are not really addressed for a number of years because of the court system and the way that works, and because typically, in my experience, you get very little done at the administrative level. So compare that to the New York City Tax Commission, where at least you've got a good chance of getting something done. It may not be exactly what you want, but in most jurisdictions outside of New York City, it's a long wait until you get some substantive attention. So if you say isolate a jurisdiction outside of New York and you just picked a particular property type and you said, well, I'd like to get a handle on how the assessor is treating this property type. Let's say it's multifamily. I'm not going to say it's impossible, but it's really difficult to get any kind of a clear line on what the assessor is thinking or how they're treating it. Or, I just had a question from a hotel owner the other day about, well, what's the assessor's policy on valuing hotels? And the answer was, who knows, because first of all, there's very little data in the assessor's file to look at. Secondly, in a jurisdiction that's not doing an annual revaluation, the assessor may have a lot of policy ideas in his or her head, but can't implement those. And I'm not really making a comment on whether it's smart to do revals or not smart to do revals, and there's a lot of discussion about that. But the reality is that if the assessor is limited by law from reassessing a particular property based on what they think the market is doing, then looking at that assessment is not going to tell you very much. It might be an assessment that was set 5 years ago or more. And how do you compare that to what, what the market looks like today? Or if, let's say, you were representing a new, like a developer or something who wants to build a hotel or wants to build multifamily property, and wants to know how is that going to be assessed? Well, looking at the other properties that look like that in the jurisdiction won't tell you very much. So I think that that's just a complicating factor in a lot of places in New York. And by the way, municipalities and school districts struggle to budget for all this because part of the budget process would involve knowing what's coming. And when I say what's coming, I mean, as a result of pending certiorari's, where they may end up, looking at the claimed value, which I know a lot of them do. Looking at the claimed value on a petition is meaningless. Those claimed values could be as low as $1, and it's just really a placeholder until there's a substantive sit down to talk about real value. And often, as I say, that doesn't happen for many years. So how do you budget for that?
Somebody mentioned that when valuing properties for certiorari, you value the fee simple and do not consider the leases in place. What do you do if rental rates have been declining and a property is currently leased at an above market rent?
I'll start with an answer, at least from the legal side of things. The standard in New York for valuation, and I'm talking New York as a whole, is fee simple, unencumbered. But the challenge is what does unencumbered mean? And the debates that I've seen and been involved in seem to me to go to two sort of extreme ends, neither of which is necessarily the right answer. One extreme end, we talk about dark store theory, and a lot of times, and it doesn't have to be stores, but a lot of times the assumption from that is that dark store means that you're valuing the property as if it was completely vacant, which to me is really a distressed property, or could be a distressed property. Maybe for some others it's an opportunity. But a lot of that depends. You'd have to kind of get under the hood, so to speak, to look at why the price was paid. At the other end, we've seen situations where leases in place, if you really picked apart the lease, you might find that the lease includes things that are not simply market rent. They might include amortized construction costs or other things. Maybe some of those that are specific to a particular tenant, like in retail, you'll see that a lot. So there too, at the other end of that, that might seem to be an above market lease, and you'd really have to look at that and see, what's behind that lease. What's the lease all about, rather than just looking at the face rent. So the simple but maybe not so simple answer to the question is that the standard is fee simple unencumbered. Unencumbered referring to leases that may not be at market. So the real question for the appraiser is, what is market rent? Especially in nowadays, that may not be such an easy question to answer, where the data is what it is. But that's, ultimately that's the answer. So, and that's why I mentioned earlier that a lot of times the sale is sort of considered a proxy for this standard of fee simple unencumbered. But is that really true? I think in a lot of cases it's probably not true. But it's almost simpler to say we're not going to try to get into the heads of the people who made the leases or the people who bought and sold the property. It's an easy way out. But I don't know if anybody else on the panel wants to respond as well.
Well, in New York City, they use the leases and will account for the credit rating of the tenants, as well as the end of the lease term, and the argument of whether those generally show up in the cap rate. If you've got AAA tenants, that's one thing. If you've got tenants that are on the verge or in bankruptcy, that's a whole different story, and the risk is obviously greater.
A couple of our panelists have asked, I wonder if you guys have a crystal ball on the tax rates for New York that might be coming out. What are your thoughts?
It's, again, I think the city council is, because the way the real estate tax is done, there's an overall levy that is put in the city budget. This is how much they want to raise from real estate taxes. You take away from that a reserve for refunds or reductions that will come during the year, or for that matter, collection losses, since there is a slowdown in collections. So while they're going to try to hold the line, I believe the political imperative of holding the line on real estate taxes is there. The question of that's the tension between the people who want to spend more and who have constituents that don't see their real estate taxes directly, if they're renters, or they might not be as tied in or as aware of the real estate tax increases, versus the city council members that are representing 1, 2, and 3 family homeowners, every one of whom knows how much real estate tax they're paying. By the way, the New York City real estate tax rate on Class 1 properties, because it's a very low assessment ratio at 6%, the rate is 19 point something. It's about almost 20%. And that's a tough number to tell people you're paying a tax rate of 20% a year.
Bad optics. Ting, do people contest assessments for properties with abatements and exemptions?
It depends on what part of the life cycle of the tax benefit that you're currently in. So I'll start with 421A. As I mentioned earlier, 421A exempts the any increase in assessment from the base year, so to speak. So it would not make any sense to challenge the taxes in the early years of the 421A because of the 100% exemption. However, once you get towards the end of the life cycle of 421A, the exemption amount does decrease, and then it would be beneficial for an owner to challenge the taxes once the 421A benefit decreases when it's less than 100% exemption. On ICAP, the way that the ICAP is very quirky, it's complicated, and I can talk about it for like a full hour. The way that the ICAP benefit is measured is actually the first year's increase in taxes, and then whatever that increase is, it's kind of frozen and becomes your benefit, so to speak, with some caveats I won't get into. So it's counterintuitive. You want your increase to shoot up as high as possible that first year in order to maximize your ICAP benefit for the remainder of the years. So you absolutely should not file a cert on an ICAP during that first year. But in some instances where the ICAP benefit is frozen and it's not all of the increase, it would be beneficial to file a cert for ICAP. So it's definitely important for cert attorneys, if they're not familiar with exemptions, to speak with someone like myself who is familiar with how exemptions work, so that the cert attorney is not accidentally shooting the owner in the foot in challenging something that is actually not beneficial at all to the tax benefit.
Just to chime in, the other thing, I agree with Ting completely. She's absolutely right. There have been instances that I've seen where once the ICAP is being looked at or being put in place, or that the assessor might increase the value of the land because that's not covered by the ICAP or any of the or the 421A exemption. So you have to keep an eye out. You know, it's one thing to say land may have gone up by some value because of the building and the improvement on it. But I've heard stories about assessors saying, well, now that you have a building on it, the land has tripled in value, which shouldn't be the case. The other thing is I tell all not-for-profit 420A owners that they should keep an eye on the assessed value for two reasons. One, they transfer the property, that assessed value is going to kick in as soon as the property is transferred. And if it's too high, you're going to lose money if you're looking to sell the property. And it's just good to have an idea of, in case there's a partial exemption or, like I said, a sale, you want to at least keep an eye on that value and see that it's in the ballpark, and file a protest if it's not.
Yeah, to Glenn's point, we've seen a lot of situations where, because the property is under, say, a 420A, which is the, full-on exemption, for, as Ting had mentioned earlier, something that I'm not going to say a 501c3, but something that might include a 501c3, but basically a not-for-profit use or something. A lot of times those exemptions are just completely, or the assessed value, not the exemption, the underlying assessed value, because there always is one, is just ignored because nobody really cares as long as it's that exempt. It's, as Glenn said, when the sale occurs, sometimes if it's been ignored for a long time, and sometimes you do have a situation where an exempt owner may have owned the property for 50 years or more, and just nobody ever looked, and the assessment could be vastly inflated over true market value. And then all of a sudden the purchaser comes in, and I think also, as Glenn was saying, it's a kind of a one-way street with the exemption. The municipality, the exemption will generally kick in from the assessment roll on which you've made your application for exemption. But if the municipality is able to basically get paid on the taxes from the date of the sale to the non-exempt property owner, that's when your tax is going to start. So you may have a situation where the buyer is completely taken by surprise by a greatly inflated tax assessment that kicks in from day one. So again, just something at least to consult with somebody about and sort of choose what's the best way to handle that.
Another question for Ting. What are we expecting after the 421A program expires? And is it fueling a lot of potential new construction?
Yeah, so I've definitely personally have seen uptick in interest. I have a lot of calls from clients and developers lately about sites that they're looking at right now because they're looking at the calendar. They know that they need to start construction on June 15th of next year. So time is limited when you take into account the time it takes to get the permitting process and then finding a site, entering into contract. So I think maybe a broker or an appraiser might speak better, but I'm assuming that there might that might affect land prices right now because of the increase in interest due to the expiration. And we've gone through this already once or twice before. 421A also expired in 2015. It also expired in 2008. Last time it expired in 2015, there was no new 421A for close to 18 months. And I think a lot of developers are keeping that in mind. They're scared that because last time, so we know what happens when 421 expires with no replacement. Last time deals dried up, the pipeline dried up, like New York City development just stalled because without the 421 exemption, it's very difficult to pencil out a project in New York City due to the high cost of construction, the high property taxes. So developers are definitely nervous about the future of 421A, especially given the current political climate in Albany, because it is not a very real estate friendly political climate right now in either Albany or the city. 421A is an animal of state statute, so it's passed by the Senate and Assembly, but the city politicians definitely have a lot of influence over how the state legislators vote on 421A. And right now, 421A is always a political punching bag.
Yeah, it is. I just riff on what Ting was saying. I'm not going to talk about 421A, but just more broadly speaking about what Albany does and what legislators do. I'm personally working on a number of bills that seem to keep cropping up. It's a little bit like whack-a-mole, where these bills come up that are often motivated by, local homeowners. And there's a kind of a myopic approach to dealing with taxes that doesn't recognize, what I always believe is really the value of the integration of all property types within a community, and what the commercial side adds and what the residential side adds, and all everything that's sort of in all other uses in between. And a lot of times you get these bills that are not very well thought out and really problematic. And if they tend to cause problems to the commercial owners side, because they're not really regarded as the voters side. And there's a bunch of them right now that are bouncing around that are truly problematic. And I think, unfortunately, the end result is that the commercial sector gets beat up, and ultimately you have businesses looking to go elsewhere outside of New York. And that's kind of unfortunate.
A question for Mike. You talked about winners and losers in commercial real estate, with certain sectors performing well during the pandemic and others taking big hits. Are you seeing the tax burden shifting between property types, between different owners, and the potential kind of battle between who pays and who doesn't?
Yeah, and again, if you want to think about it, a couple of different ways, but you're right, there will be a burden shifting, and it, to the extent that the residential now, again, in the suburbs where you've got annual appreciation growth of 10-15% in some markets, and then you have we talked about the ratio before, which is going to be the equalization ratios in certain municipalities, where that's going to be decreasing by that amount. At the same time, your commercial properties, some may hold the line, and then some are obviously going to be suffer dramatically. Yeah, you're going to get a shift. And whether or not the revaluation, so to the extent that you do a revaluation based on true numbers, there's certainly going to be a shift to those properties that have benefited to the extent that others haven't. And I think that in terms of the commercial property types, we've already heard Dan discuss what's the properties in the hospitality business, but I'm looking at industrial transactions in the region where the values are just mind-boggling in terms of what our historical perspective has been. The logistics market, the cold storage, some data center sales. I mean, certain aspects of what they call alternative assets have been increasing dramatically, much more than some other, commercial types. So yes, I think a shift is definitely in order.
I think it's interesting, Mike, too, because, and I think we've talked about this a little bit, is that the in one sector in particular that I think of is multifamily, where you're seeing a flight of capital out of the city and into the suburban metro areas. And so, and while on the one hand you're seeing steep drops in New York City multifamily valuation, you're seeing kind of a corresponding increase in demand to buy and build multifamily in the suburbs, which seems to be where people are going. And big question is, for how long would that remain true? Is that just sort of a moment in time issue, or is that something that could be a long-term trend? And obviously, why will that depend? A lot of that will depend on what people decide to do as things ease up in terms of COVID. One other thing you mentioned, Mike, that I just want to amplify a little bit is equalization rates. There's, and I sort of open this as well, especially to Glenn and Ting, as far as it concerns New York City. But equalization rates are kind of well, I was going to say they're an interesting topic. They might be only interesting to people like us, but they're an interesting topic in the way that they're arrived at. As Mike said, outside the city, in the city, and I'm just talking about the the commercial class, you've got a 45% ratio that holds true year to year, and outside the city, you've got a ratio that changes every year and changes by the jurisdiction. And that's, I think that, talking to this audience in terms of appraisal, it's really important to understand that distinction and know the rates. The rate will change outside the city every year. And as Mike mentioned, it's dependent on what the market's doing. And there's a fairly complex methodology that New York State Office of Real Property Tax Services uses to generate those rates. But essentially, it's a weighted ratio that includes commercial valuation. It's a sampling done of commercial properties as well as residential sales. And the ratio tends to be weighted. And by the way, outside of New York City, there's only one ratio for I'm going to generalize, but I'm going to say for most municipalities, there's only one ratio, not multiple ratios, depending on the asset class. So you'll end up with a ratio that could apply to a commercial property that's being driven by residential sales. And it tends to be that the weight is heavier on those residential sales. So we look at at the direction of the market and what's happening in both the residential as well as commercial sectors, because they impact each other. So I think that's important. The one other thing I'm just going to mention, and I'm going to sort of put this out to Glenn and Ting. They may have more to say that's intelligent than I have on this, because it's a city thing. But I noticed one of the questions was about why, let me just see if I can actually pull it up here. It says, it's talking, oh yeah, so the city keeps the equalization rate at 45%. And, sort of like, what's the justification there? And tends to ignore sales. Now, my understanding has always been that that's the two sort of work hand in hand with each other. In other words, were the city to look at sales more, you'd have a very different ratio. But I think that's an interesting topic. I think there's other people on this panel better qualified than me to speak about that.
Of course,
question about how the courts are looking at things like stabilized value or alternatively distressed sales, and how much those come into factor for.
Well, I want to hang on one second, Mark, because I think Glenn was going to follow up on the ratio.
Yeah. So the city's ratios have been the same. The 45%, it goes back at least 25 or 30 years. They haven't changed any of it. There was one attempt to go up to Albany. I know that some folks, Gary Schechter and some others, went up to Albany to try to convince the state, the Office of Real Property Tax Services, that the city had to change its assessment ratio. It is complicated. It's heavy statistical analysis, and nobody wants to touch it. The only time that the assessment ratio came into play in the 12 years that I was president of the Tax Commission, and by the way, the Tax Commission form says you can challenge the assessment ratio if you want. I mean, that's one of the things to consider, but is never done. There was one case where a practitioner submitted I guess it was a request to admit that the city law department didn't answer in time. And that one property got an assessment ratio of I think 30 some odd percent. But it was a mistake. It's just one that slipped through because the lawyers weren't paying attention. That is a huge issue. And I don't know that anybody's going to touch it.
Well, I was waiting for Ting. I was waiting for Ting to values. Yeah, I was waiting for Ting to jump in on that, and I see her nodding in agreement.
Oh yeah, Glenn covered it all.
So I wanted to ask a question of David, which with regards to, again, and it goes back to what Glenn was talking about, the fact that the I&Es are looking at 2019, yet we know and can anticipate 20 and 21 income and expense statements will drop significantly. But yet again, if I were to negotiate a settlement that freezes or locks in my assessment going forward, I cut myself off from future benefit of reduction. And I, David, know you've spoken or written about this recently. So I was wondering if you could share some of your insights with our audience relative to the aspect of freezing taxes going forward, your assessments going forward.
Sure, Mike. There's a law under the real property tax law at section 727 that, with some exceptions, basically says that if you're in a jurisdiction that's not annually revaluing or updating its role, so right there we've carved out New York City and a few others, but in I guess about the majority of New York State, once you've resolved your assessment appeal through a court proceeding, that assessment's then frozen for the next 3 years. Now, first of all, some owners take it as my taxes are frozen for 3 years. Your taxes are not frozen, it's the assessment. So the mill rates will change, but the assessment is basically frozen with some exceptions, like you've done improvements or something like that. But the big one would be that the municipality is doing a reassessment of town citywide reassessment or an update. And, you know, in many of these jurisdictions, they don't do that. So what Mike's getting at, and something that I have written about, and something that this particular statute, in my humble opinion, firstly, is an unconstitutional statute. I think that there is I know that there's a provision in the New York State Constitution that says that all real property is to be valued not in excess of its fair market value, its full market value. So to the extent that a municipality carries forward an assessment for the next 3 years that may or may not exceed its full market value, I think there's a constitutionality problem there. But I think, and this is really more to what Mike is getting at, is that you end up in some tricky situations being the advocate for the owner, where you're faced with the prospect of getting a case resolved, or maybe taking a case to trial and getting it resolved, where in a situation exactly like the one we're in right now, where we've known what the income was, let's say for 2019 or 2018 before that, but we might not quite know what's going to happen over the next 2 or 3 years to the income, particularly where we're in a pandemic. And, you know, we've got these drastic negative impacts on many different types of assets in real estate. And by having the case resolved, either because you've settled the case and, you know, you're trying to do the best you can for the owner and get some resolution, or you might be getting forced to try the case, take the case to trial in court. And my firm has had personal experience with exactly this, where you're forced to go ahead with a trial based on income from pre-pandemic. And now, whatever the result is going to be, that assessment's going to be frozen for the next 3 years, where you know that the income is going to be substantially worse, your value is going to be going substantially lower, and yet there's nothing, you're really hamstrung to do anything about it. So there's a lot of tactical thinking that would go into a case like that. And that's, you know, the best I can say. It's something to have a very detailed conversation with your client about, to really make sure you're on the same page, and really make sure, you know, as Glenn said about the t-shirt, managing expectations, make sure the client knows what to expect, because there's some important, I would just call them business decisions that a client has to make about what they want and how soon they want it.
And although it's less formal, there had been in the back of all the hearing officers' minds at the tax commission that you don't go below a prior settlement. If you settled the case last year at X dollars, you know, at an assessment of X, you don't go below that. Now, I will tell you that the current president of the New York City Tax Commission, Francis Henn, who worked with me at the law department, has said that they will be advising hearing officers that you look at the numbers, and wherever the numbers lead you, that's where you should go. Don't pay attention to a settlement from a year or 2 years ago, because conditions were different. The other thing I wanted to mention, just the income and expense statements that have been filed with the tax commission, most large office buildings are on accruals. They accrued the income. They didn't get the income. They accrued it. And that's what the city is looking at in terms of income and expense statements. And they have their own guidelines for what vacancy losses and collection losses may be. And those may get some flexibility. They may allow a few extra percentage points on the vacancies and a little bit more on collection losses. But right off the bat, you've got this disconnect between the accrued income that was shown on the income and expense statement and what was actually received in cash.
Mhm, mhm. That actually, by the way, triggers another thought. I know we're running out of time. I'll make it brief. We just talked about the 3-year freeze. One of the exceptions to the freeze is a 25% change in occupancy, which sounds good on the face of it. I mean, good for the owner. You've got a substantial change in circumstances. But what do you do where, we've got lots of properties where they're not paying rent, but that's not really necessarily a change in occupancy, or it would require a kind of a nuanced interpretation of occupancy, I guess, at best. And that's a real problem, and I think that's, again, comes back to lawmakers maybe having a well-intentioned idea there, but it wasn't very well thought out in terms of practical realities.
What about change in use? Ting, are you hearing about hotel properties being converted to or contemplated for conversion?
I've had a
to
number of
apartments?
clients kicking the tires, especially given the press that it got, when it was inserted into Cuomo's budget proposal. However, I'm told that the numbers don't make sense without a property tax exemption put in place specifically for this kind of work. The only available exemption, as I said earlier, is 421A if you want to convert a property into market rate units. And like I mentioned before, there's a mini tax. The mini tax is the taxes that you would pay, but like all throughout the life of the 421A, and the taxes are measured based upon what you paid before construction. Well, for a conversion, the taxes you paid before construction was on a hotel. With new construction, you pay taxes on dirt, which is generally very low. But if you're paying taxes on a hotel, it's already a pretty high tax base to start with. And the clients I've spoken to have been kicking the tires. None of them have pulled the trigger.
Dan, it sounded like you're hearing a lot from owners looking for tax relief on hotels, and your take is that they're difficult or few and far between, or?
I mean, clearly the sector has been decimated, and I didn't talk about where we are in terms of valuation. I think it's safe to say that broadly speaking, and we do have some empirical evidence that points to post-COVID hotel values being, generally speaking, being down anywhere between 15 and upwards of 50%. Right now, that's a nice broad range. That's nationally. I will tell you that we have looked at assets recently where we're starting to see price discovery at values that are equal to 2019, so pre-COVID. It is remarkable what's happened just in the past 14 to 21 days in terms of outlook and investor perception. Hotel investors tend to be an optimistic bunch, and maybe it's because the sun is now higher in the sky, given that we're in spring. But the outlook in the sector is really very bright at this point. There's an inordinate amount of money sitting on the sidelines looking for opportunities. There have not been that many opportunities, or at least compelling ones, that have bubbled up. And the ones that do bubble up end up invariably getting bid up. So what we're starting to see is, transactions that are being forced due to stress, right? But the pricing does not necessarily reflect distressed pricing. So clearly, values are rebounding quicker than net income. And that's all due to investor perception. But coming back to your question about the taxes, yes, I mean, and it's logical to want and expect relief in tax burdens. I think, it would be very noble if that were to happen, but I just don't see how that can possibly happen. Tax assessments on hotels I mean, everybody should appeal their assessment. No ifs, ands, or buts about that. I'm sure everybody's entitled to some sort of a decline in their assessed value. But again, the investment community is on the buy side is not baking in any assumed declines in tax burdens.
Great. Well, I think we're pretty much out of time. I want to thank everybody here. It's been a great program. We hope to be putting on more of such programs in the future. Look for one in May. And the chapter thanks every one of you for your time and sharing your expertise. Thank you again.
Thank you.
Thank you.
Thank you.
Thank you. It was fun. Everybody be well.
Take care.
Take care.